the foundation of wealth generation. It's often called the eighth wonder of the world. In fact, it was the legendary physicist Albert Einstein who is widely credited with describing it as the most powerful force in the universe. This isn't a riddle. It's the fundamental principle of compound interest. To truly grasp its potential, we must first distinguish it from its simpler counterpart. Imagine you invest $1,000 with a 10% annual return. With simple interest, you would earn $100 every single year. After 20 years, you'd have your original $1,000 plus $2,000 in interest, for a total of $3,000. It's a decent return, but it doesn't harness the full potential of your capital. Now let's see what happens when we introduce the magic ingredient of compounding. Compound interest is interest earned on your initial principal and also on the accumulated interest from previous periods. In that first year, the math is the same. You earn $100, but in the second year you earn 10% on $1,100, not just the original $1,000. This small difference is the seed from which a financial forest can eventually grow over decades of patience. This process transforms linear growth into an exponential curve. Your money starts working for you, and then the money your money earns also starts working for you. If you're ready to understand precisely how to put this force to work in your own life, consider subscribing for regular insights. The difference between simple and compound interest is barely noticeable in the first few years, which can often lead to impatience and discouragement for new investors. The real power isn't in the first year or the fifth, but in what happens when this process is left undisturbed for decades. The unstoppable snowball effect. This slow start is much like packing a small snowball at the top of a very long hill. At first it's tiny and moves slowly, gathering only a little snow. This is the perfect metaphor for how your investments grow when powered by compounding over a lifetime. The first, Sarah, starts investing $300 a month at age 25. That 10-year delay cost John over $500,000. He invested only $36,000 less than Sarah over his lifetime, but his end balance was dramatically smaller. The years you spend invested are far more impactful than the exact amount you contribute, especially when you are just starting your financial journey. Simply divide the number 72 by your expected annual rate of return to find out roughly how many years it will take for your investment to double. This simple calculation powerfully demonstrates the exponential nature of compounding over a long time horizon. Each new dollar you add is another worker sent out to generate returns, further fueling the compounding engine, the economic engine behind the numbers. The returns that fuel compounding aren't pulled from thin air. Your investment grows as these companies innovate, sell products, generate profits, and expand their operations over time. Capital appreciation is the increase in the market price of your shares, reflecting the growing value of the underlying businesses. When you reinvest those dividends, you are buying more shares, which then generate their own dividends, perfectly turbocharging the compounding process. It's absolutely crucial to understand that this is just a historical average, not a guarantee of future performance. The key is to harness this engine through a long-term strategy. By owning a piece of the broad market, you are essentially betting on human ingenuity, progress, and economic growth over the coming decades. This is the objective analysis that underpins a sound investment philosophy focused on sustainable growth. However, this powerful engine does not operate on a smooth, predictable track. The path to long-term returns is paved with volatility, uncertainty, and periods of economic turmoil. Understanding and preparing for these challenges is just as important as understanding the growth potential itself, as it is during these difficult times that many investors make their biggest and most costly mistakes. Navigating volatility and invisible threats. The journey of a long-term investor is never a straight line. Market downturns, recessions, and corrections are not a matter of if, but when. These periods of volatility are a natural and unavoidable part of the economic cycle. For the unprepared investor, they can be terrifying, often leading to panic selling at the worst possible moment. True investors, however, understand that these are temporary storms. A long-term perspective is your greatest defense against this volatility. By focusing on a time horizon of decades, not days, you can ride out the downturns. In fact, for those who continue to invest regularly, these periods are opportunities. A strategy like dollar-cost averaging allows you to buy more shares when prices are low, which can significantly enhance your returns when the market eventually recovers, as it historically has. Beyond the visible threat of market crashes, there is a silent, invisible threat that erodes your wealth over time: inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If your investment returns don't consistently outpace the rate of inflation, you are actually losing real wealth, even if your account balance appears to be growing. This is where diversification becomes your most important tool for risk management. A well-diversified portfolio spreads your investment across various asset classes, such as domestic stocks, international stocks, and bonds. This strategy helps to smooth out the ride. When one asset class is performing poorly, another may be doing well, helping to cushion your portfolio from the most severe impacts of a downturn in any single area. Building a diversified portfolio ensures that you are not overly exposed to the fate of any single company, industry, or even country. It is a foundational principle of modern finance designed to manage risk without completely sacrificing the potential for strong returns. But what does a practical, diversified portfolio actually look like for the average person? And how can you build one efficiently and effectively for your goals? Building your personal compounding machine. Constructing a resilient portfolio doesn't need to be overly complicated. For many, a simple and effective approach is a three-fund portfolio. This typically consists of a U.S. total stock market index fund, an international total stock market index fund, and a U.S. total bond market index fund. This combination provides broad diversification across thousands of companies and different asset types, capturing global economic growth at a very low cost. The vehicles you choose are just as important as the allocation itself. Low-cost index funds and exchange-traded funds, ETFs, are often ideal for implementing this strategy. They are designed to mirror the performance of a market index rather than trying to beat it. This passive approach significantly reduces management fees, ensuring that more of your money stays invested and continues to compound for your benefit over the long run. Every dollar you pay in fees or taxes is a dollar that is not working for you. Over several decades, even a seemingly small 1% difference in annual fees can consume a massive portion of your potential returns, effectively sabotaging your compounding machine. That's why prioritizing low-cost funds and utilizing tax-advantaged retirement accounts, like a 401k or an IRA, is a critical part of any successful long-term plan. To truly harness the power of compound interest. Over the long term, you must remove emotion from the equation. The best way to achieve this is through automation. Set up automatic contributions from your paycheck or bank account to your investment accounts every single month. This strategy forces consistency, takes the guesswork out of market timing, and builds a disciplined habit that will pay massive dividends down the road. With a well-diversified, low-cost portfolio and an automated investment plan in place, you have assembled all the mechanical parts of your wealth-building machine. You have the engine, the fuel, and the system to keep it running. However, There is one final non-negotiable ingredient that is entirely up to you. It's the one that requires no money, but for many, it is the hardest one to acquire. The ultimate strategy: patience and discipline. This principle of allowing time to work its magic is the core philosophy of the world's most successful investor, Warren Buffett. His own wealth is the ultimate testament to this power. The vast majority of his multi-billion-dollar fortune was accumulated after his 50th birthday. He didn't rely on genius stock picks. He relied on time, consistency, and the relentless engine of compounding. You will inevitably face psychological challenges. When the market is soaring, the fear of missing out, FOMO, will tempt you to chase hot stocks and abandon your strategy. When the market is crashing, fear will scream at you to sell everything and run for safety. Giving in to either of these emotional impulses can be devastating to your long-term success. Discipline means sticking to your plan through thick and thin. The power of compound interest is not a get-rich-quick scheme. It's a get-rich-for-sure strategy, provided you give it enough time. It's about consistency and patience, not about genius stock picks or risky bets. It's an accessible path to financial independence for anyone who is willing to start early, stay consistent, and maintain a long-term perspective through all market conditions, good and bad. Let's end with one final, powerful illustration. A 25-year-old who invests just $400 per month and earns an average 8% return will have over $1.3 million by age 65. That is the mathematical certainty of this incredible force. What is your biggest financial goal for the future? Share it in the comments below. I'd love to read what you're working towards. For more deep dives into building sustainable wealth, make sure you are subscribed and have notifications turned on. Thank you for watching. Disclaimer: the content in this video is for informational and educational purposes only. It is not intended to be a substitute for professional financial advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal situation.